Welcome everyone to today's webinar, How Government Contracts Qualify for the R&D Tax Credit. We have Robert Jones with Left Brain Professionals here with us today, and he has brought along some colleagues from Hull and Knarr that he'll be introducing shortly. My name is Liz Brigson. It's a pleasure to be your host today. To get the most out of this presentation, I'd like to encourage you to use the GoToWebinar questions pane for live interaction. We're excited that you're here, and we really would like to answer your questions and make this interactive. So we already have our first question actually. Is this for U.S. government R&D? So Robert, I'll probably ask you to address that right off the bat when I introduce you. So yes, please interact with us out there. We have really great resources with us. You'll have probably 4 or 8 eyes on the Q&A box today. So please keep your questions coming. You can download the handouts. The handouts are accessible from the GoToWebinar control panel. They'll also be available to you from your Corsa dashboard. We'll launch 4 polling questions for this 1 credit hour webinar. And in order to receive CPE credit, you'll want to respond to a minimum of 3 of those 4 questions. And if you do qualify for CPE credit, you'll be able to download your Corsa certificate 1 hour after the conclusion of the event. And if you have any questions, always email us at support@incorsa.com. Well, Robert, thanks so much for bringing us together today. Robert is the government contracts and accounting expert. He's the principal and partner founder of Left Brain Professionals. He has a background as a controller, a defense contracts manager. He's an instructor and speaker, a recurring Incorsa presenter, and we just always hear great feedback about the work and education that Robert is doing in the government contract accounting space. So Robert, I'll turn things over to you. Thanks for introducing us to Hull and Knarr, and let's get started.
Yeah, good afternoon or good morning. For those of you who are on the West Coast like me, thanks for joining us again. Normally it's just me from the Left Brain Professional side, but we have recently partnered with Hull and Knarr on R&D tax credits, and specifically how government contractors can take advantage of this program. There are a number of myths out there. I'm going to turn the floor over to Carlos here in just a few minutes. He'll dive deeper into today's topic and be able to answer some of those questions, including the first one. I'll take a first little stab at it. It says, is this for U.S. government R&D? I think I know where the question is going. I'm going to clarify and say that we're here talking about U.S., obviously U.S. taxes, U.S. government contracts, that we do know that some U.S. government contractors have R&D work in other countries for other projects and stuff that they're working on. And I'll leave that aspect of the question to Carlos to chat about. As Liz said, my name is Robert Jones with Left Brain Professionals. We're a boutique accounting firm, practice primarily accounting system design, implementation, and audit support. We work only with government contractors. And when we met up with Carlos and John a while back and learned about how a part of their practice also connects with government contractors, we saw that it really made sense to bring you this information and to bring this information to our clients. Our learning objectives for today, we've got 60 minutes together. At the end of this, you should be able to describe R&D tax credits, to define what are considered includable expenses, list the criteria that are necessary to qualify for the R&D tax credits, and describe the impact of contract type on obtaining these credits. With that, Carlos, I'll let you chat briefly about Hull and Knarr here.
Yeah, I'll actually take that one, Robert. That was a late switch here, but we at Hull and Knarr, we specialize in R&D tax credits and other local incentives. So from our perspective, what makes us unique is the fact that we use an engineering approach. But by the engineering approach, essentially that's degreed engineers that go in and they're able to talk with the technical departments within an organization, and it gives us a better opportunity to go in there and define what is qualified and what is not. From our perspective, we can work with the company, other accounting firms, other strategic advisors, venture capital firms. Bottom line is just trying to make sure that we can capture this benefit for as many companies as possible. And then lastly, just to reiterate, we are not an accounting firm. That's really important. We actually are partners with a lot of accounting firms. And that's something that we can obviously get into a little bit later as well.
Yeah, and I think that that's a good connection to what I had said, why they work with us, right? While we specialize in government contracts, they specialize in that R&D tax credit. And as John said, right, that they work with firms like us. And again, I already shared a little bit about us. Those of you who have been on our previous webinars know that we do a lot of work with cost and price analysis, incurred cost proposals, audits, and related items. The relationship here, and I just want to speak to a moment about this, right? There are multiple people that are involved in this process, right? Hopefully, if you're one of our clients or somebody who has looked at working with us in the past in government contracts, the role that we play here is overall government contract compliance. We also look at accounting processes and procedures. We know that a lot of what Hull and Knarr and Carlos's team will often find as they're working with you down there in the green, the government contractor. If you're one of the firms that's out there, you're in the yellow down there on the bottom left. There's a lot of communication among us. We all have different roles in this, right? So there is a role for the accounting firm. We know there's some accounting firms that are on the call today. You have a role in this as well as we do. With that, our first polling question, so I can get this over to Carlos and let him dive into the meat of this. What do you believe is the main reason why most providers don't feel comfortable in including government contracts in the R&D tax credit calculation?
Yeah, this is a really good question. While we're watching the audience responses coming in, maybe Carlos, if I could just ask what your perception is of why many government contractors don't believe they're eligible for the R&D credit.
Yeah, no, that's a good question. Obviously, it's very central to this presentation here. At the end of the day, we see a lot of government contractors shying away from it, particularly because at face value, the statute, the code, excludes certain activities that are considered funded research. But the definitions of funded research go a little bit further than specifics and get into specifics of what actually constitutes funded research. And a lot of times, just looking at the code, somebody could be under the impression that they wouldn't qualify, right? Just simply put. But when we get into it, we'll get into it here a little bit later, but when we get into it, you'll see that what is funded research is a sliver of things that don't qualify. And that misconception alone, though, keeps a lot of people from exploring it further, asking more questions. You know, it's really kind of a limiting factor, as we see for a lot of government contractors.
Yeah, thanks for that background. So we're going to go ahead and close this poll down, and we'll take a look at our audience today and see their results. So looks like just over a third didn't know they could be included, which goes along. Another third say it's too complicated. So I'm sure we'll break down some of those myths today to break down the complexity. And then the remaining third is mixed between either what you said, the tax code statement about funded research, or just maybe hearsay. At some point they were told couldn't be included and didn't look into it. And so really glad that you're here today just to kind of renew the education on this space and hopefully maybe challenge some of those pre-existing beliefs and know that the door is open. So thanks for that. We'll go ahead and put the poll results away. And I'm going to go ahead and pass the presenter controls to you, Carlos. So you should have that pop up here right on your screen. You can accept, and we'll let you know when we can see your slides.
Okay. You guys see those slides?
Not yet, just might need a moment.
Let me know when you can see it.
Robert, I'm going to go ahead and pass back over to you, and then we'll do one more pass over to Carlos.
Okay, and while we're working through the technical here, I want to address one of the items on the poll there, the 33% who said it's too complicated. I guess what I'll say is that the 67% of that I'll kind of leave to Carlos. He'll talk about the rules, regulations, what qualifies, what doesn't, why. Part back to this partnership that we have and the role that Left Brain in particular has in this is helping people through that it's too complicated aspect. One of the things that we've talked about with Carlos and John. And do you want me to drive the slides, or do you want me to pass it back to Carlos here?
Let's see. So Carlos, are you getting that pop up on your screen to share? There we go. Perfect.
Yeah, and while he's doing that, I'll just finish my thought there. The too complicated is where we can step in and help clients with their accounting system set up, making sure that they've got projects, jobs, other things in the systems, various tags, codes, reporting that will aid Carlos and his team in the future on gathering the information that they need.
Yeah, no, that's true, and again, we'll get into that here in just a few minutes. Can you guys see my screen now? Is that working for you? Okay, very good. Yeah, so thanks again, Liz, Robert, for putting it together, the opportunity to bring some clarity to the research tax credit, particularly as it refers to contractors with the government, the U.S. government. The question here, I'll go ahead and answer it right away. U.S. only. The activity has to take place in the United States. You could be doing work, as Robert alluded to, you could be doing work for a foreign government, but the activities themselves have to be taking place here. Likewise, you could be doing work for the U.S. government, and the activities perhaps would be taking place elsewhere. Those activities that take place elsewhere are not qualified for the credit, are not eligible for the credit. The fact that you are contracted with a government of a different country doesn't preclude you from including those activities as R&D potentially, but the activity has to physically take place here in the United States. Having said that, let's get into it and get some background on the R&D credit. I'm curious, this is not a polling question, but I'm curious here to see how many folks have looked into the R&D credit, have a good understanding of the R&D credit. If you guys could just kind of chime in, I think, John, if you monitor that, you can let us know what folks are saying. At the end of the day, the polling question gives us a little bit of an understanding there of where everyone is at. But I'm wondering how much time you spent really looking into and figuring out, talking to, if you are an accounting firm, researching the topic. If you're not an accounting firm, talking to your accounting firm and figuring out if you're eligible, those kinds of things. Before we get going a little bit deeper into what the credit is, I'll start the basics here, and John, if you can chime in before we end this slide here, just to kind of let us know. At the end of the day, the R&D credit is a financial reward for businesses to create or improve products, processes, or software in the United States. And this financial reward comes in the form of approximately, between the federal and the state credits, somewhere between 10 and 12% of those eligible qualified R&D costs. So it can be pretty valuable, as you can imagine, to get another 10% or so of R&D costs. Okay, so as you get a contract and then you have costs associated with that, you can really stretch how much of a benefit you get, in addition to obviously doing the work, the R&D work, and getting paid for that, but also getting some additional benefit in the form of dollar-for-dollar offsets, in other words, tax credits. The credit historically has been only available to be used against income tax liability, but as of the last few years, starting with tax year 2016, the credit can be used in certain circumstances basically for qualified small businesses. It can be used against payroll tax as well. So again, a few avenues there. If a company is not able to use the credit right away for whatever limitation, perhaps they don't have tax liability, the credit can be carried forward for 20 years on the federal level, and then the states vary, but it's somewhere between 10 to 18 years worth of carry forwards. So again, fairly profitable, fairly useful credit for companies in a variety of different industries that could involve R&D. This part of the presentation isn't just exclusive to government contractors, okay? Outside of government contractors, there's plenty of companies doing R&D, and they, again, are eligible as well. Now, specifically, what does it mean here since we're talking about government contractors? You know, historically, again, we saw in the poll results, right, a lot of government contractors don't take advantage of the credit. They're either unaware or don't think that their activities are eligible. For whatever reason, they're leaving quite a bit of value on the table by not including those government contracts as potentially eligible activity, by not including IR&D, bid and proposal, and so forth. At the end of the day, what you're eligible for is to include all the R&D activities that you're performing from beginning to end, from conceptualization all the way to what the code calls point of commercial production. Okay, so if you spend some time in bid and proposal doing conceptualization, I think that could be the beginning of your R&D process. If you're doing it on your own as IR&D, or if you're doing it in conjunction with a government contract, with the caveats that we'll see here in a little bit, those can be transformed into R&D credits, which, as we talked about, will reduce tax liability, no doubt, but also, for a lot of companies, improve their cash flow. If you're thinking, what else could we do if we had a little bit more money, right? We could hire somebody else, or we could do some marketing, or we could do X, Y, and Z, buy some equipment, for example. That's what the R&D credit was designed to do, to incentivize companies to continue to push technology forward here in the United States. And for accounting firms, you know, that's on the company level, on the business level. For accounting firms, we exist to provide the extra layer of compliance that when you go and file that return for your clients, you have the certainty that the background information is there, the documentation is there to support it should it be audited. One of the things that we'll do that's different than a lot of our competitors is to offer the audit defense as for no additional cost. So we will get the credits, we'll identify the credits and the activities that qualify for it. We'll also be there to defend it should be necessary. So you have the peace of mind as an accounting firm that this isn't just the first, you know, our first offer as a lot of our competitors will do. This is the number that we believe as engineers, as practitioners in this space, that we believe the taxpayer is entitled to, and we'll go and defend that as well. So that's a little bit different than what you might see out there from folks. If you've had some contact with the R&D credit providers, you'll see that that's a little bit different than what others might do. Okay, so a little bit of background on the R&D credit. Now, at face here, just some things that we can look for and look at to identify if there's potential for the R&D credit. So a few things here, just the ones that apply the most to this crowd here, I believe. You know, if you've got degreed engineers or scientists on staff, that's a great indicator. Obviously, won't necessarily tell you how much you would have an R&D credit, but it certainly is one of the points that you can rely on to begin assessing, do we have something that qualifies? If you've got a patentable product or production method, that should be a pretty telling sign as well. If you manufacture a product with a highly automated process, that normally indicates that there's quite a bit of process development or process improvement related, which again is an eligible activity. If you develop software using new algorithms, techniques, or architecture, if you're in the field of cybersecurity, for example, which is going through a lot of innovation right now, that's an indicator as well. If you're creating software that has a built-in API, or you're creating an API for your software, again, that's a good indicator that you're doing something that others aren't doing. Therefore, there's potential for the R&D credit as well. And then if you've been awarded a R&D project through the SBIR, SDTR, OTA, etc., other government avenues, that is a good indicator as well that you most likely have R&D eligible expenses just based on the nature of those programs. And here we get to the next polling question. So I'll go ahead and ask this one. Or Liz, do you want me to throw this back to you?
Yeah, definitely. So this is the second poll, and the question is, which is an indicator of qualified research activities? And it looks like we do have a couple of questions. So let's start with the first question from Joel while we're waiting for the audience to respond to this poll question. Is there a minimum value of contracts which would make this cost beneficial to pursue? What about using the R&D tax credit on an S Corp? Can you only apply that to payroll wages, or is there another option?
Yeah, no, those are great questions. So I don't think they were necessarily connected to each other, right? So I'll go ahead and answer them separately. Minimum value of contract. For us, if you're asking specifically for us, will we help companies with X amount versus Y amount, etc.? It's really flexible. At the end of the day, we're more focused on helping companies take advantage of benefits that are out there and been around for over 30 years, rather than can we all get paid, those kinds of things. That's a an effort that we'll make to educate you or companies that are interested in taking advantage of the credit, so they can do it on their own. At minimum, they will get the information to do it. If it makes sense to hire somebody like us, then particularly from a time perspective, then obviously we'll engage. Minimum value, you get about 10% as a tax credit. You get about 10%. If you get a tax credit that's in the range of $20,000 to $30,000, that's $200,000 to $300,000 worth of eligible expenses. That's probably one phase 2 fixed price contract gets you to that point already, right? So you could have one contract and make it worthwhile for yourself as a taxpayer to engage in this kind of activity, to be able to take advantage of the credit. But it's also a question of what's material to you as a business. To me, $20,000 to $30,000, if I was a government contractor, I would value that, and I could put that to good use. So even one contract that phase 2, for example, would be enough for me to engage. As far as the S Corp question, Liz, was the question specifically about using it against wages?
Yeah, the question was, can S Corps use the R&D tax credit? And then the subsequent question was, is that only applicable for payroll wages?
Okay. Yeah, S Corps can definitely use the credit. It just flows through to the shareholders. In the case of an LLC, for example, would flow down to the members and then be applied to their personal returns. There are a few limitations there, but the short answer is yes, it definitely is applicable to all types of entities, including sole proprietorship. Can it be used only against payroll wages? So let me expand on that real quick. There are two ways to use the credit. One is against income taxes, which wouldn't necessarily have any bearing on whether it gets used against wages or payroll, etc. That's just the company is profitable and is paying taxes at the end of the year. They show income tax liability. You can offset that. Now there's an election that can be made to use the credit against payroll taxes. So those payroll taxes are the taxes that are withheld from W-2 employee payroll.
Very good. Well, thank you for the detailed response to that question. And Joel, who asked the question, he said thank you as well. Good to address that. 98% of the audience responded to the poll, so awesome engagement. Thank you, everyone. Correct answer is all of the above. So we'll put the poll results away and send it back over to you.
Awesome, thank you. So moving on here, now that we know a little bit more about the R&D credit, what it is, what it's not, what are some of the R&D expenses? So the first one, and the one that really we see the most contribution to R&D credits are wages. The wages to pay for the labor and so forth that goes into R&D activities. So here we typically see, from the government contractor's perspective, the PIs are going to be ones that we're going to be pulling wages for. Obviously, engineers are working on a project. managers with any technical input, technicians, particularly if they're creating or assembling prototypes, and again, the last piece here, production and assembly personnel. The types of wages that we can include are, I guess, the types of labor we can include. It's all W-2 wages. Our direct R&D, so people like engineers, for example, and PIs who are directly working on the project. Direct supervision, that's why I mentioned managers. So you could be a manager who is directing somebody else who's doing the direct R&D, and that supervision would be includable as R&D credit. And then direct support. So again, technicians, production, assembly personnel, that's where they would come in. Again, capturing the full span of R&D activity through the organization, from conceptualization all the way down to right when a prototype is verified and the concept is validated. The second type of R&D expense here is materials, also called supplies. So again, things that are used in the process of qualified research. It could be prototypes, those are sort of the obvious ones, experimental deliverables, for example, but also materials that go into a process development. So if you're in a very sort of rudimentary example, if you're buying sheet metal for a particular process, proof of concept for a process, that material would be considered an R&D expense as well. Pilot runs, again, towards the end of that R&D process, you're beginning to create a process to manufacture. You might have a pilot run that could be includable. And then software that's used in R&D, that's another common expense as well. That is considered a R&D expense, eligible expense. And then the last category here is subs and consultants. So commonly, as you guys know, you might have to go outside of the business, outside of the company, to get some capability or some temporary help for particular projects. In the case of SBIR program, you may actually be required to go out and work with somebody else for whatever reason, right? Anybody who's doing any of the R&D pieces, which could be design, testing, it could be assembly, it could be any one piece or whole pieces of that R&D activity, those can be includable as well, even though they're outside consultants. I want to say here too that statutorily, these expenses with outside contractors, that is, these expenses are includable at 65% of the eligible value, okay? So if 100% of it would be includable, at the end of the day, 65% is included in the calculation of the credit. Wages and materials are includable at 100%. Okay, and then another polling question here. Liz, I'll let you take it away.
All right, that sounds great. So recapping, qualified R&D expenses include all of the following, except which one listed below? Wages, facilities, materials, or subs and consultants. And we're seeing a few members of our audience have taken a chance just to chat us in the questions box. So John, you're probably reading just to see some of the different backgrounds and experiences that our audience today has with the R&D tax credit. So Ruth shared that this is quite new to her today, but becoming more familiar, which is really exciting just to be able to learn these concepts. And then we have another attendee, Cheryl, who says she's very familiar and also has a great question that we're going to save for a little bit later because we're ready to close the poll down. But yeah, thanks everyone for checking in. If you haven't had a chance to let us know just your general background and baseline with the R&D tax credit as it relates to government contracts, we'd love to hear from you. So let's close this poll down, take a look at the results. I think this poll was maybe a little trickier than our first two because results are a little more split. So majority of the audience said facilities, 57%, followed by subs and consultants. So who's right?
Yeah, so facilities is right on this one, right? Wages, materials, and subs and consultants are the includable expenses.
All right, awesome. Good recap point right there.
Yeah. So going on here, so criteria to include government contracts. So first and foremost, the activity has to pass the definition of R&D for the credit itself. Congress, through the Section 41, through legislation, has essentially defined, and through some of the regulations, have essentially defined what is R&D that is eligible for this credit. If you're an engineer like me, you might be thinking R&D is something very in the lab, very scientific, and it has to be, no doubt. But it can also be a little more expansive than our typical definition of R&D. What we look for is for the activity to pass what's called a four-part test, commonly called a four-part test. It has to pass these four bullets here. Okay, so in number one, it has to be technological in nature. It has to rely on the hard sciences primarily. So, for example, physics, engineering, chemistry, biology, computer science, those are all hard sciences, whereas you could have marketing research, right, that's got research in the name, but it's research in a soft science, therefore it wouldn't be qualified for this credit. Number two, the activity has to involve technological uncertainty. Simply put, technological uncertainty means that at the outset of that project, you don't know exactly how you're going to get to your end result. If you did, there wouldn't be any uncertainty. You would know technological uncertainty, that is. Maybe there's business uncertainty and some other kinds of uncertainty, but not technological uncertainty. At the outset of that project, do you know exactly the appropriate method, design, or capability? If there's questions as to those, then there's technological uncertainty. Number three, there has to be a process of experimentation. That process of experimentation exists to reduce, mitigate, or exclude any technological uncertainty. So, in other words, you'll take that uncertainty. Let's say you didn't know exactly what the design needed to be in order to get to your desired goal, your final performance goals. That process of experimentation is going to allow you to create one or more alternatives to get there. It will allow you to evaluate those theoretically, probably physically as well in the case of prototypes, for example, and then iterate through that to optimize and get to the end result, hopefully before you deliver that to the government or other commercial clients. And then lastly here, number four, the activity has to be for a permitted purpose. So it has to be for some, as I like to say, to create or improve some measurable aspect of that product, process, or software. So, fit, form, function, quality, reliability, those are some of the things that we can measure, we can track. Whereas if you have a cosmetic, for example, reason for undertaking an activity, that wouldn't qualify because of its subjective nature. Okay, so cosmetic, gooey, seasonality, taste, those kinds of things wouldn't qualify as a permitted purpose. If an activity passes all four parts of the four-part test, it's eligible R&D. There are a few exclusions to the R&D credit, some of which pertain here. We kind of discussed one when the question was asked about U.S.-based R&D. That's one of the R&D exclusions, in that the activity has to take place in the U.S. There are a few other ones that don't really pertain that much to our discussion here, but the one that does is the one that I mentioned earlier, specifically from Section 41, that talks about funded research. Okay, so funded research meaning that as you read the text of the code, it says the funded research is research paid for by an unrelated entity. And that's where we're going to spend a few minutes here providing a little more clarity on what that really means based on the regulations, based on some case law. But really, to begin with, okay, this funded research is a topic that's been around for a long time and very misunderstood. It really comes down to two very key aspects of the contractual relationship that you have, either with the government or any other commercial entity. Okay, this isn't necessarily exclusive to the government, but certainly it plays into this conversation here. First, the contract has to put the financial risk on the company performing the R&D. Okay, if it does so, in other words, if those payments are based on milestones, satisfactory completion of those milestones, and they're not going to be on a reimbursement basis, okay, that puts the financial risk on the company doing the R&D. So if you're an accounting firm, your client, if they are required to be successful in order to get paid. In other words, they have to deliver something, they have to deliver reports, they have to deliver prototypes, etc. in order to get paid. That's a good sign. If you're a taxpayer, same thing, that's a good sign. If you are getting reimbursed no matter what, basically by putting in hours to a project, then that's not a very great sign from a financial risk perspective. The second key aspect of the contract that needs to be there in order for it to not be funded research, okay, so these two are for us to circumvent the funded research, is that the company has to maintain rights in the research results. At the very least, that intellectual property has to be shared with somebody else. In the case of the SBIR STTR program, that's a very clear point, because those two programs, they are designed to give the rights to the contract, to give the rights to the company performing the R&D. Yes, the government does share in that as well. They have the rights to modify, create derivative work, so on and so forth. But the SBIR program is designed with that in mind, to be able to get small businesses in that R&D process as well. But keep in mind those two key aspects, okay? That's really what drives whether or not a R&D, otherwise R&D eligible activity, in other words, the activity that passes the four-part test we just talked about, those two aspects, the financial risk and the rights, are what keeps a company from having their R&D excluded as funded research. Okay, so let's dive into that a little bit deeper here. You get into this next. There we go. So this isn't necessarily case law yet, but we'll get to it here in just a second. This is from the regulations. Okay, the regulations in section 1.41-4 says that funded research is qualified research, does not include in research to the extent funded by any grant, contract, or otherwise another person. This is what I mentioned to you guys earlier. Okay. Now there are, as it goes on here, there are a few more things that we can look at to understand this topic of funded research a little bit better. In general, research does not constitute qualified research to the extent it's funded by any grant, contract, or otherwise by another person. Amounts payable under any agreements that are contingent on the success of the research and thus considered to be paid for the product or result of the research are not treated as funding. Okay, so that's the first big indication we have here of how funded research really works. If the amounts payable under the agreement are contingent on the success of the research, they're not funded. Okay, so that's that first financial risk piece that we talked about a second ago. If my research, my payment for conducting research is contingent upon success of the research, in other words, me delivering something that is accepted by the government and then I get the payment, that's not funded research, okay, according to the regulations. Second point here, research in which taxpayer retains no rights. If a taxpayer retains no substantial rights in research under the agreement providing for the research is treated as fully funded. Conversely, we can make the inverse argument of that, okay? So if a taxpayer retains no substantial rights, it's fully funded. But if the taxpayer retains substantial rights, it's not fully funded, okay? And we'll see that here in the next slide as well, that again, the risk aspect of the contract is very key, very central to whether or not it's funded research. And then the last little piece here from the regulations is research in which the taxpayer retains substantial rights. In general, a taxpayer does not retain substantial rights in the research if the taxpayer must pay for the right to use the research, the results of the research. Okay, so if I give it away, I give away the research rights or the rights to the research results, and I do not have the ability to use it unless I pay for it, then I do not have substantial rights. Again, conversely, if I can still use the research results, the IP that I produced in my R&D process, whether or not it's related to a contract, then I do not have funded research from the rights perspective. Okay, but let's dive a little deeper here into the case law and see how these regulations came into play in real life. There's really two, when we talk about funded research and the R&D credit and how it pertains to government contractors and contractors in general. If you're performing your R&D under a government, under a contract in general. There are really two cases that are the most commonly cited, and the ones that we're going to talk about here: the Fairchild Industries case and the Lockheed Martin case. The first one, just to kind of give you guys a little bit more insight here as to how the financial risk and substantial rights plays into this funded research question. First one is this Fairchild Industries here. It was really a case regarding financial risk, where it helped strengthen and clarify some of the issues that we have faced as practitioners in this industry. The details here is that the lower court had argued that because the Fairchild had progress payments, that did not put the financial risk in Fairchild's court. The appeals court found that they reversed that decision. They found that the progress payments from the government to Fairchild did not alter the provisions of the contract that put Fairchild at risk for the development. So at the end of the process, the court held that whether research is funded depends on who bears the research costs upon failure, not on whether the researcher is likely to succeed in performing the project. At the moment when the research is happening, who is on the hook for that financial, for the cost of the research? If I'm going to ultimately be responsible for that financial risk, if I'm not successful, then I have the financial risk, okay, not the government or not some other entity. Again, the second case that we see that pertains a lot to this particular topic is the Lockheed Martin case, and that case was really more about substantial rights. The government, in that case, the government argued that the taxpayer only retains substantial rights if the taxpayer retains the rights to exclude others from its research. So really, it went all the way down to, you have to have basically patent rights. In other words, you're going to be able to exclude everybody else from using this particular technology or the research results. But the appeals court found that the rights to use the research without paying the customer, even if not an exclusive right, is substantial right. Okay, so from these two court cases, what we can identify is that funded research is only excluded if a company both gives away the IP and gets paid, even if they don't successfully meet the milestones. So, for example, you guys are familiar with government contracts, an LOE type of contract where all I have to do is expend a certain amount of effort and get paid for it. Otherwise, includability comes down to rights retention and financial risk. Okay, that's a little bit more information there on the funded research topic. I'm sure there will be some questions that will come out of that, so happy to answer here. But let's go to the next polling question here, Liz.
Yeah, and we're going to go ahead and just talk about this as a discussion question. A good recap here. So includability, as Carlos was talking about, comes down to which of the following: the right retention, the financial risk, who pays for the work, or both A and B. So if you want to go ahead and type your response in the questions box, then you are welcome to do that. But again, this is not an official poll question, just a discussion question. And from listening in, I'm going to go with D, Carlos, both right retention and financial risk.
There we go. You got an A.
All right. So, and it looks like we're getting, everyone that's typing in an answer in the questions box, now that they've heard my answer, are also saying D. So yeah, great job, everyone, and thanks just for taking that pause to reflect there.
Yeah, and let me pause here just one more time. This is the single biggest reason why most folks are confused about the funded research issue. When you read the code, it does say, as I read earlier, it does say that if you've got research that's paid for by somebody else, that you're not entitled to that. You have to exclude those activities, exclude those costs. But it really is, it gets deeper than that as you go through the next layer, go through the regulations, and you begin seeing that it's not just who pays for it, but there's really the rights and the risk aspect of it. And then the case law sort of confirms that in if you were to read the cases, obviously you get a lot more context as well. But it really clarifies that at the end of the day, we're looking for those two things to be present, and in order to be able to qualify those, to include those as R&D. Again, making sure that it does still pass the 4-part test, that it is the kind of research that the credit is going to incentivize. But yeah, very good here. So both A and B, so letter D. In practice, this is what it means for the taxpayers and for your clients, if you're an accounting firm. The contract types can indicate how likely they are to qualify. Okay, very, very easily here we can see that there are types of contracts that are very, very low likelihood of being includable. For example, a T&M contract, where you are getting reimbursed for your time, getting reimbursed for your materials. There's not a single point where, in the vast majority of cases, there's not a single point where you have to demonstrate that you are successful in doing what you're doing in order to get paid. The payments just come as you spend time or as you spend money. Okay, so those are going to be very low likelihood. An FFP, LOE, as I mentioned earlier, if you're just required to put some amount of effort into it, but not necessarily be successful in delivering something, whether it's the research results or a prototype or proof of concept, then again, that's going to be very, very low likelihood of being includable. The next two, though, is where things get interesting for you guys as taxpayers and your clients. Medium level of likelihood here, we've got CPFFs. Okay, not for most CPFFs, particularly if they are, for a phase 2 typically, right? That type of R&D, type of activity will be considered R&D, but most of that effort is going to be done on a reimbursable basis, except for perhaps the last payment where it's withheld. So there's some portion of that might be included, but again, it's not a high level of likelihood. Commercial contracts can be 50-50, depending on who is contracting you to do the work. You may have a favorable contract from the R&D credit perspective. You may not. Unbilled direct, I should say. Again, 50-50 here. It really depends on the circumstances. But then on the last box here, the high likelihood of being includable, we've got fixed price contracts, particularly if you have payments tied directly to milestones. If you have 5 milestones, they're each $20,000, and in order to get paid that $20,000, you have to deliver something that has to get accepted by a TPOC, for example, before you get paid. That constitutes, again, payment contingent upon success. Because of the SBIR program, the rights is going to be favorable towards you, the taxpayer, your clients. Fixed price contracts are going to be highly eligible here. IR&D, you don't actually have any of those issues, right? You're paying for it yourself, so again, you're going to have high likelihood. Bid and proposal, once again, you're not getting paid for those. Even though you can get reimbursed on an indirect basis, there is a very clear direction in the regulations that talk about IR&D and bid and proposal being includable, therefore not funded research. And then cost overruns, even if it's for CPFF. If you have a cost overrun, you're not going to get paid for those. You are therefore at risk, financial risk for those. Once again, you would have the R&D risk and the intellectual property related to that, therefore high likelihood of being includable. So just by looking at this sort of cheat sheet here, you can start thinking about, what do we have currently in terms of contracts, or in the past few years. If you haven't taken advantage of it, or even if you have, you can go back and amend your tax return for previous years that you had qualified activity but not taken advantage of the credit. So what types of contracts did we have this past year, 2020, and the last 2-3 years? Is it in the high bucket? Is it in the low bucket? And begin assessing how much of that activity would potentially be includable in the credit. Typically, we see that, and Robert can speak more to this, but typically we see that costs associated with projects run at about 50–60% of the revenue, that direct cost, that is 50–60% of the revenue that comes from that contract. So by knowing how much revenue you got from those types of contracts, you can quickly get to a number of what you should expect in terms of R&D credit. That's just kind of a quick back of the envelope to help you assess how much credit could be there, what the opportunity would be. And then from a time perspective, you know, Liz alluded to this earlier, so I just want to at least make a comment. From a time perspective, really for the vast majority of contractors with the government, you have to have an approved accounting system. You're keeping track of time for the majority of contractors. So that really speeds up the process, makes it a lot simpler to tie dollars to specific projects. Okay, so typically speaking, the amount of time that's required from you, the taxpayer, or you, the client, if you engage a firm like Hull and Knarr, for example, there's a certain amount of investigative work that needs to be done by our engineers with the scientists, technical personnel at the client. That typically is, you know, somewhere between 1 and 2 hours every 10 engineers. Okay, so it's not super onerous. If you have 50 people, that's about 4 to 5 hours worth of conversations, and then whatever much time it takes for accounting folks to dig up time tracking information, wages, and direct expenses. The rest of it is with us, and we would put together the calculation, the report, and all of the supporting documentation. So it's designed to be as streamlined a process as possible for you guys. Okay, Liz, and we have one last polling question here.
Yes, so this brings us to our last poll, our fourth poll. Some contract types are more likely to qualify for the R&D credit than others. And this is really good just to be cognizant of this going into the conversations, to really scope the projects, to understand what the contract types are that are on the table to qualify for the credit. So responses are coming in quickly here, so we'll just give about 5 more seconds and close the poll down. We have a few questions already in the queue for our Q&A, so we'll make sure to cover those. Okay. We'll share the results real quick. Correct answer is true. Back over to you.
Yeah, and that's, again, just thanking you guys for being present here with us, taking some interest in the R&D credit and how companies can benefit from it. Hopefully the time here has given you a little bit more clarity on what can be included and what shouldn't be included. At minimum, we hope that you guys walk away knowing how to have a conversation with potential providers or your accounting firms. If you're an accounting firm person, again, that you know how to look at particular companies, clients of yours, and assess if there's an opportunity there. As you guys know, you're welcome to reach out to us, reach out to Robert as well as Left Brain Professionals, and if you have any more questions on R&D credit or things that relate to it, happy to help as much as we can.
Thank you, Carlos. This has been fantastic. We want to bring Robert and John back on if you guys would like. We have about 4 to 5 minutes or so for questions. So Jenny on Robert's team is also online. She's been helping to monitor the questions box. So Jenny, let's go ahead and just start with a couple of the questions that you've been tracking throughout the program today.
Sounds great. The first question, do you have updates on how the PPP loans are going to affect our R&D savings?
Yeah, so that's been a kind of an ongoing conversation, and we've had a lot of questions in that topic. No, we don't have an answer on whether that's going to impact the R&D credit. In theory, it will not impact the R&D credit. But I do have a lot of questions in that vein, so we're keeping tabs on what's happening there as far as the legislation and the guidance that has been given to us as far as whether it will preclude companies from including those kinds of expenses. if they've been covered by the PPP. Unfortunately, not a whole lot of guidance right now.
A good question coming from a R&D expert, I'm guessing, who's also in the trenches with you. All right, question number 2. What's next?
This one is a little long. So theoretically, what if it meets the 4-part test and payment is dependent on milestones and deliverables on a firm fixed price contract? Phase 1 is research only and not development, which is phase 2. According to the slide low, it may still not qualify, correct?
So in that case, it sounds like a phase 1, and I could be wrong here, but it sounds like a phase 1 where really the primary goal is feasibility, right? Can we use this technology to apply this technology to a certain problem to arrive at a solution, and then you get some sort of result at the end, some sort of answer at the end. So generally speaking, that is still eligible activity, okay, if those payments are contingent upon milestones. So the milestones could be simply reports. The technical reports are being delivered to the government that have to be accepted by the TPOC. Even though there's no physical, prototype or deliverable proof of concept, most likely that's still a qualified project. We see that a lot.
Great, and if we have time, we have one more question. What do you know about the geosyntech case?
We know about it. This part of it's another obviously another case that's pertinent to the R&D credit. Without the specifics on what we're looking for here with the geosyntech, it's another case that pertained, but it really didn't change the definition of funded research as we see them today, as we understand them today. So really, don't think it makes a big difference in what can and can't be included from a government contract standpoint. But yeah, it's not one of the ones that we rely on for the funded research issue.
If we have time for one more, it just came in. Based on your audit defense, how contentious are the contract terms?
So, a lot of this comes down to being able to have conversations with auditors that know that these aspects of funded research, right? If they don't, then we are in many ways educating them as well. Okay, so that those audits tend to go pretty well, because once they understand that the regulations are there, the case law is there. Every auditor in the IRS isn't 100% versed on the R&D credit. In fact, they have separate engineers that audit the R&D credit as well. So those guys tend to be a little bit more well-versed, but the auditors themselves not always. If we get somebody that understands the funded research topic a little bit more, then it's really a matter of showing the terms and conditions, for example, of a contract, and identifying how those fit the profile of financial risk, of IP, etc. The vast majority of audits we're involved with, particularly because we do a lot of the due diligence up front, go very smoothly, go very well. We have a very high retention, dollar retention in audits, in that, by and large, we don't lose. That's kind of the gist of it. But we have a very good relationship with the IRS, very good relationship with a lot of state departments of revenue, for the reason that, we're very transparent in what's been included and what's been claimed, and how all of that is documented. Eventually, as you guys know, you're accounting professionals, you do get somebody who's a little bit more persnickety about things, but that's okay too. We're here to get the right answer.
Excellent. Well, thank you for taking those questions. That was fantastic. We are at the top of the hour, so let's go ahead and just conclude really quickly. I want to make sure that Robert, if you wanted to have any closing comments, and also make sure we can talk about your webinar coming up next month.
Yeah, Carlos, if you'll just advance the slide. For those of you who have been participating with us in our regular series, so today's topic was not part of that, we do have number 11 in our 12-part series for 2020 coming up on November 10th. That's on job costing for government contracts. And then in early December, we will have episode number 12, which is on the incurred cost proposal.
Excellent. We're looking forward to that. And there's a couple additional courses that are available through self-study format as well. So a couple quick things to wrap up. There'll be a course survey. We'd love your feedback that will pop up on your screen when you close the GoToWebinar control panel. And then you'll be able to log into your Incoursa user account to access your CPE certificate. The recording will be uploaded later on today, and then also the materials are already out there on Incoursa on your dashboard. So thank you for joining us. If you have any questions, don't hesitate to get in touch with Carlos, Robert, or John. Thank you, gentlemen, for an excellent presentation, and we will look forward to having you back with us again soon. Until then, take care.